Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
Sabhya, I'm sure you've learned a lot since you've been buying rental properties, but what would you say is the number one most important thing that you've learned?
Yeah, Dan, through my investing journey, I've realized that while numbers might seem good on certain properties, even above 1% rule in certain lower income neighborhoods, uh, the actual truth is while operating, for me, it has been that the a little bit higher income neighborhoods might yield better actual return because of low maintenance costs and low vacancies, and that has been a life changing or almost strategy changing journey for me that I've learned through my 3 years investing in real estate.
Sabhya started out buying good properties in good neighborhoods. Everything was going great. The properties were pretty easy to manage. He was getting a pretty good return, but he saw that if he bought cheaper properties in a not so great area, he would get a much higher return. So he found a couple of deals, ran the numbers, thought he had a home run, but the deals didn't quite work out as well as he hoped. He had a lot of problems. He had a lot of expenses he wasn't counting on. And overall, it really just didn't work out for him. So on the show today, we're going to figure out what happened, see if maybe there's something that he could have done differently. A lot of people are very successful with lower end properties. So we'll get to the bottom of what happened and see what you could do to be successful with cheaper properties. Joining us on the show today from Chicago is Sabhya Katia. We'll take a quick break to thank our sponsors. We'll come right back and we'll talk to our guest. Investing in rental properties can be complicated, but it doesn't have to be. My friends at MidSouth HomeBuyers sell completely rehab turnkey properties in both Memphis and Little Rock, and they've been doing it for 23 years. All their properties come totally rehab. They put on a new roof, new kitchen, new bath, new plumbing, new electric. Everything is brand new. They also have a tenant that's moved in before you close, so you get cash flow on day one. MidSouth HomeBuyers also continues to manage the property for you after closing. It couldn't be easier. Everything is 100% done for you. All their properties also come with a couple of guarantees. They have a 1-year total maintenance warranty and a lifetime occupancy guarantee. Personally, I just closed on my 5th property with MidSouth HomeBuyers, and I couldn't be happier. If you want to talk to a happy customer, reach out to me. I'm happy to answer any questions, or you can check them out at midsouthhomebuyers.com. Real estate, it's been a cornerstone of wealth building for generations, but it's also often a major headache for investors. 3 a.m. maintenance calls, tenant disputes, property taxes. Enter the Fundrise Flagship Real Estate Fund, a $1.1 billion real estate portfolio built for you. We're talking more than 4,000 single-family homes in thriving Sunbelt communities, 3.3 million square feet of in-demand industrial facilities, all professionally managed by an experienced team. With the Flagship Fund, you're tapping into real estate's most attractive qualities: long-term appreciation potential, a hedge against inflation, diversification beyond the stock market, check, check, check. All without complex paperwork, massive down payments, or soul-sucking landlord duties. Visit fundrise.com/RIP to explore the portfolio, check out historical returns, and see just how easy it can be to add real estate to your investing strategy. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise Flagship Fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement. It's a lot of work to find a really good rental property, and when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender, and her specialty is helping investors finance rental properties. She has a ton of loan programs, and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com, NMLS 42056. Let's start things off talking about your portfolio. What does your portfolio look like today?
Yeah, Dan, my portfolio today looks like it's 23 units in total that I have between Chicago and Milwaukee.
And you've said you've been investing for 3 years?
Yeah, just a little bit over 3 years. I started in 2021. Actually, I started early 2021, but bought my first home in Q3 of 2021.
Awesome. Well, let's talk about that first deal. So, how did you get started?
I got started with how most people in this industry get or in this journey get started is by buying a triplex as a house hack. So I lived in one of the units and rented out the other two.
All right. So, with you living there, did you have a small down payment?
I did, yeah. So I bought my first deal as an FHA, so 3.5% down. Obviously, we are talking September 2021, so the interest rates were pretty good, as you can imagine.
Mm-hmm.
But on the flip side, there was a bidding war on every property that I bought or that I was trying to purchase. I got outbid on a couple of homes, and then this one kind of really worked hard. Developed a relationship with the seller side broker. My broker developed a relationship with the seller side broker, and that's how we were able to get this deal.
All right. So it's a 3 unit. You're living in one of the units and then renting out the other two.
Yeah, so I got it as one of the units already had a tenant and grandfathered in. He actually lives in the unit to this day in that very unit. The second unit, I did some TLC with some painting and refinishing the cabinets and such. And the third unit, which I eventually ended up living in for 1 year, was a gut rehab. So I did everything from mechanical, electrical, plumbing, flooring, new bathroom, new kitchen, everything.
So that's pretty cool. So you kind of experienced everything. A little bit of a tenant that had been there. It was like a long-term tenant.
Yep, yep.
Okay. And then you got the experience with the rehab. Was that harder than you thought it was going to be?
Oh yeah, 100%. It's
Yeah.
always 20 or 30% over in time and budget,
Yeah.
which it ended up being, but we still were pretty good in terms of budget because I was kind of running to Home Depot every time, and I was there at the property whenever the contractors were in place and making sure that they're being guided properly because otherwise they'll just place anything anywhere.
Yeah.
But it was definitely harder than we thought. What was challenging, even though I had some idea of the neighborhood, what was challenging was understanding whether some of the amenities might get me more rent or not. For example, I was wondering whether putting in a dishwasher or a washer dryer would help me fetch better rent or increase the property value. So had a little bit of a harder time and talked with my broker a couple of times or my agent who helped me buy. But that's kind of that's another hurdle that I had to overcome.
So what did you
Just
figure out? Like,
understanding.
did you end up doing that?
I did end up doing the dishwasher, because didn't end up costing too much. It was the cost and benefit analysis that I was doing on all these.
Yeah.
But getting the hot water lines up and running for the washer dryer as well as the space required didn't seem like the right fit. But what we did was move. So our initially the water heater was in one spot that was basically bang in the middle of the kitchen. However, it was configured before, and we spent a bunch of money to move the piping around so that it could be in one of the closets. And that really changed the look and feel of the kitchen. It improved the lighting. It also gave extra cabinet and countertop space. So that really changed things, and I was able to rent it much higher than I even anticipated
Awesome.
going in when I was underwriting the deal.
So you mentioned at the beginning that one of the things you learned is that if you buy in a good neighborhood, it's going to be a little bit easier. So it sounds like this property was in a good neighborhood.
Yeah, it is. It's in a Avondale neighborhood of Chicago, which is a very up and coming. It's right north, a little bit north of Logan Square.
Okay.
This neighborhood is very up and coming. It's actually been rated one of the best neighborhoods in the country as well. One of the times, it's got great restaurants up and coming. It's white collar people, and it's correct connected directly to the airport as well as the city. So people who are working in downtown Chicago are usually people who are living here.
Okay, awesome. All
Yes.
right, so you had a good experience. It sounds like that property worked out. What was your second deal?
Yeah, once the first one worked out, as most people do, I got hooked, and I was like, oh, okay, I can do this again. And a couple of months later, almost 8 months later, I partnered with someone to buy a triplex about 10-15 minutes away from the first house that I bought in
So
Chicago as well.
why partner? Like why not just do it on your own?
Down payment.
Okay. Okay. All right.
Yeah.
So you and the partner each put in half the down payment.
We did, yeah. So what we did was essentially we got an FHA loan together on his name, and then we shared the title, which is 50-50, and we did the down payment 50-50. I found the deal, and then we managed it together.
And was he living there in the property?
He did
Okay.
live there for one
All
year.
right.
Yeah,
So he's doing a house hack and you're basically half owner of the property.
I am. Yes.
Okay.
So
Awesome.
the other two were rented out. In terms of the economics, the other two were rented out, and that was obviously going towards the expenses and such. And then we estimated what his rent would be, and then he didn't pay his half, and he paid me the other half.
Okay. So
Essentially,
he paid you half the rent of what the market rent would be.
yeah.
Okay. Perfect. All right. So then what did you do after that?
Yeah, after that, I was looking for opportunities in Chicago, but this now fast forward a couple of months. This was early 2023. So we were getting up in the sixes and six and a halves of the interest rates. Chicago didn't really seem like it was working out compared to the twos and the threes, the low threes and the high threes that we'd seen. So the mortgage payments were very different. And I, through some contacts, got to know about a flipper as well as a property manager in Milwaukee, which is 1 hour north of Chicago by driving. So I started evaluating and then eventually started investing there by the summer of 2023.
Now, is this when you kind of went down to a lower neighborhood?
Yeah, yeah, essentially. So I was trying to go in with a strategy or a mindset of cash flow or cash flowing properties. So for that reason, I went down into a tier of lower income neighborhoods,
Okay.
thinking, yeah, because my property manager said that they'll be able to manage it. And I did go around the neighborhood couple of times before that, and I knew there would be some issues, but the cash flow, the numbers were and are good on paper. So I ended up, or I started investing in that area.
So like give us like a ballpark of like to compare like the
Yeah, yeah,
properties you were buying in Chicago versus Milwaukee.
yeah, yeah. So Chicago, I bought the first triplex that I bought was for $450,000. So we're talking about 160, 170 a door, maybe a little bit higher. But the one in Milwaukee that I was buying was a duplex for 200, sorry, 150,000, so 75 a door.
Oh
And they
wow. Okay.
were,
So it's a
yeah,
lot cheaper. And
lot cheaper, and 75 a door. We are saying the door rents for about 11 to 1200, and yeah, so about 1150, $1200 is what it rents
all right,
for.
so that's over the 1% rule. Like so that's
Oh, certainly.
yeah, so that's really good. So so on paper you're thinking, oh, that this is great. You know, the
Mhm.
returns look awesome, but like what kind of trouble did you run into?
Yeah, so before this, I was in a pretty decent to high income neighborhood in Chicago. As I transitioned to Milwaukee, the first couple of months were good, and I bought some more duplexes and triplexes. And then eventually, it started with rents not getting paid on time. And sometimes it happens, it gets delayed and such, which is why in Milwaukee we collect 2 months worth of deposit instead of just the one.
Mhm.
But then slowly it transitioned into a couple of evictions and such that I've not now unfortunately had to go through. But that's how it is
Yeah.
with these neighborhoods.
So, like, do the properties, although the returns look better, are
Mhm.
they making money, or are those properties losing money with all the extra expenses and the evictions?
So Dan, I was partially aware of this could be an issue and how I underwrote all this, how I underwrote all these properties were with 1 month of vacancy and 1 month of maintenance,
Hmm.
in addition to the property management expense and other utility expenses and PITI already, right? So even then, it was making sense on paper. So I went in for it. The actuals on these kind of properties have been a little bit higher, especially because in 2024 we saw a lot of lower income neighborhoods paying even less. You saw that in Atlanta as well. So that has been a little bit worse than I underwrote. But I think it's more about not that. So the properties are making money,
Hmm.
not as much money as I thought, but still positive.
Okay.
But I think it's a little bit more about how operationally heavy it becomes, because you'll get a call every once in a while from an inspector, like city inspector or an eviction agency and such, that you have to go through the processes.
So, does that make you want to accept a lower return because it's going to be easier and more consistent?
Yeah, that's the strategy that I eventually started transitioning to. So after that, I bought a fourplex with a buddy of mine, and we that is in a very good neighborhood. That is again in a nicer neighborhood of Milwaukee,
Mhm.
which we are talking about 100 a door, 100 to $110,000 a door. Sorry. And that's been a breeze, other than the fact that we tried a bunch of different strategies. So we tried Airbnb and midterm rentals on on that home. That didn't really work out, but other than that, the long term rentals have been pretty good.
Okay, so you're
uh,
still buying in Milwaukee, but now
mhm.
you're just buying in better neighborhoods.
Yeah, because it's in a city like Milwaukee, the neighborhood is uh if you buy in a little bit better neighborhood, you'll still get either 1% rule or a little bit lower than 1% rule,
Mhm.
which makes sense to me. And even with the 8% interest, 7.5% interest
Yeah.
rates that you're seeing these days.
Now, with the experience with the so with the properties that haven't worked out that great, are they like? Would you say they're like a C class property?
Yeah, at least, well, the properties are good, but the neighborhood is not so
Like,
great. So we're talking
okay,
about a if we talk about an A, B, C, D scale and C plus, C minus, if investors are aware of that, it's C to C minus as a
okay.
neighborhood.
Now,
While yeah,
would
that's
you
what.
ever consider maybe selling off those properties and buying in a better neighborhood? Like, would that make sense?
I think so. So what I know a couple of my friends have done is you start with a C minus neighborhood, and then once you in a couple of years you build some equity and you reposition your portfolio where you sell off the C minus assets and you buy the BB plus
Hmm.
assets with the
Right.
same equity. So you're not putting in more money from your own pocket in theory, but that is essentially always been the play, right? That you is essentially upgrade your portfolio
Yeah.
slowly,
Yep.
and that is going to be my long term play as well. Where in a couple of years' time, maybe next year, I don't know how it's going to work out, but once the property values go a little bit higher, then I would like to sell them and buy B class properties.
I think there's a couple of important takeaways here. The first one is I really like what Sabhya is doing by taking an extra security deposit. If you're renting to someone that is likely to run into financial trouble in the future or maybe do damage to the property, I think having that extra security deposit will protect you. The second thing is I like Sabhya's strategy of trading up to better properties in the future. A lot of times when you're getting started, all you can afford is a cheap property. But if you can improve the property, increase the value, build some equity, and in the future sell that property and buy a better property, I think that's a great way to go. The third thing is you can't underwrite a C- property like it's a B property. A C- property is a whole different animal. You're going to probably have higher expenses. You may have more turnover, more tenant drama. And I think you just got to realize going into that you're going to have a different setup than a B property. I think if you realize that going into it, you can be very successful with it. But if you kind of lowball yourself on what the expenses are likely to be, you're probably setting yourself up for failure. But I think overall, Sabhya is doing a great job with his portfolio. Now, in addition to his rentals, he's also started a software company to help investors evaluate neighborhoods and figure out the best renovations. It's called Prop IQ, and you can check out his website at getpropiq.com. And I'll put a link to that on the website. You can find it at rentalincomepodcast.com/episode 518. I'd like to thank Chaley Ridge for sponsoring today's episode. If you're looking to buy a rental property, whether you're just getting started or you want to add to your portfolio, reach out to Chaley. She's a nationwide lender. She has a ton of different loan programs, and she can find something that'll work for you. If you want to find out more, you can track her down at ridgelendinggroup.com, NMLS 42056. Thank you so much for checking out the podcast today. I'll be back with a new episode next Tuesday. My name is Dan Lane, and this has been the Rental Income Podcast.